We're going to talk about assessing the control risk and then reporting on the internal control structure. So basically, we're trying to obtain an understanding of the client's internal controls and the procedures that the auditors will use for, to kind of gain that understanding or to document that understanding is narratives, which is going to be a written description of the process from start to finish. Normally, they're going to ask that to be prepared by the client. They may also prepare a flow chart of actually how that process and the paperwork actually flows. And then they may come back with a questionnaire where the clients are going to list, okay, these are the things that we think could go wrong, and then what specific controls are used to stop those things. Then the auditor can always add to that. So a lot of times the auditor will ask the client to prepare these things. As a client, I was never ever actually asked to prepare that flow chart, but we did do the narratives. Normally the auditors then did their own flow chart. And then a lot of times I think they sat down and did this questionnaire also where they would just verbally say, hey, well, what if this happens? What control is in place to stop it? So then they could kind of document it and ask more questions if they needed to. Then evaluating the internal control operations, they're going to examine documents, to verify that things are double checked and that they're numbered and that they're, if they tie from an invoice to a shipping document, all those things are noted, or that if it's approved by the proper personnel, that those signatures are on there. They're going to observe procedures in action, so like verifying that the checks are locked up, that pre-numbered invoices are being used, that maybe the fixed assets have like serial tags on them or fixed asset number tags. All those things are things they could actually observe. Inquiries of the personnel that's actually performing the tasks, and then a walkthrough of the transactions at a very general level just to see that those processes are in place. Okay, then we get into this control matrix. Like the textbook has a large example of that to kind of see how that paperwork would be set up from the auditor's standpoint. But they're going to identify different business transactions that are within, so the one in the textbook is sales transactions. So what different audit objectives are related to those sales transactions? And then they're going to go down and list all the controls that are in place related to those sales transactions. Then at the bottom, there would be deficiencies. So they could have a design deficiency. So a design deficiency is that there's actually no control in place to prevent it. An operational deficiency is that there is a control in place, but it's not operating as intended. So a design is like they don't even have it. The operating deficiency is they have it, but it's not quite working. So a significant deficiency would be the likelihood that a misstatement will not be detected. And then a material weakness is that deficiency would result in a material misstatement. And then those, again, if they're significant, they're going to have to be referenced in our management letter to the audit committee, which we'll have on the last part of this PowerPoint. So again, you might want to peek at the book just to see that outline, but it's a little too large to put in the PowerPoint. Then we have your test of controls. So we've got the purpose of the test of controls is so that the auditor can evaluate whether they're likely to be effective in identifying any errors or things that could upset the audit or the audit objectives. So it provides additional information. So how do we go about that? Inquiries of the client personnel, examine the records and the documents that are in that process. So again, kind of tracing stuff through to say, here's a customer order, and then here it's approved for credit, and then here maybe it traces out to the invoice or the shipping documents and then into the invoice. So you can kind of trace it through. You can observe activities So those would be like if you could go and say, watch how inventory is checked in, so it comes in from the supplier on the desk or on the receiving dock, and then the personnel are going to check it in to their purchase order, make sure it's all received, properly put it into inventory. Again, maybe through the computer systems, or that might go to a different person who puts it in through the computer systems. Those kind of things where you can physically observe it and see that those controls are actually being done. They could also reperform if they can't actually observe it, or they can't retrace those documents to get comfortable, then they could actually reperform the task. So like take it through to say, we're going to look at a sales invoice and we're going to tie the sales price back to the master price list. We're going to trace the terms back to the customer's account to verify that they were approved for credit and these are the proper terms. So they could kind of reperform those types of things to get comfortable with that the procedures are all operating as planned. The lower the control risk that the auditor wants to have, the lower risk that they would like to assume, the more testing that's going to be required. So they want to get very comfortable that these internal control procedures are actually working. If it's manual processes versus automated controls, obviously manual processes are going to have more room for human error. Automated processes, we're going to talk later in this PowerPoint about when it's an IT function and everything's in there properly, the auditors can feel very, very comfortable that those are all going to flow as expected. The manual ones are going to maybe take a little more testing or a little more working through to get comfortable with that they are free from material misstatements and that they are, on a go forward basis that's not happening. There can be other considerations that again can impact the level of testing. If they have a reliance on the prior years and they feel comfortable that those automated controls are in place and that there's IT controls and they've already tested a lot of those, then maybe they don't have to test everything this year. They may test things more on a rotating basis. Again, assuming there's no changes. If there were changes being made, then they would have to test those. If they've already identified in their planning phase that there are some significant risks that are going to require some special audit consideration, those they're going to have to they're going to want to test the operating control procedures on those areas. And then finally, the timing. There can be some things that's only done at the end of the year, so that those are only going to be year-end tests. Other tests that they can do more at different levels, they're going to probably do it in interim timing and then just kind of touch back on those at the end of the year. So like with the oil and gas company, I think our auditors came in like probably not even at the end of the third quarter. I think towards the end of our summer, we were a regular calendar year ending date. So I feel like they came in like August to test our internal control procedures more thoroughly. And then they would come back at the end of the year, obviously, and do their audit and then ask some follow-up questions on those. Okay, then again, it talks a little bit about IT stuff in the textbook that I don't have here in the PowerPoint. Oh, I guess I do have this I did copy in this. So there's, what this is showing you here is a relationship between the assessed control risks and the extent of the procedures that are going to be necessary. So these gives you the types of procedures that we just talked about. So inquiry of the client personnel, inspection of documents, observation of an actual transaction and process occurring, and then reperformance. So if we have a high level of control risk where we're just trying to obtain an understanding, we are going to have extensive inquiries. We are going to have a transaction walkthrough, and a transaction walkthrough, we wouldn't have to do any reperformance. So if it's a lower level assessed control risk where we're actually wanting to test the controls, we're going to do inquiry, we're going to do some inspection using a sampling method, again, probably with a level of materiality. So we're testing the more, or we're sampling the more material transactions. Um, Observation, we're going to observe things at multiple times during the year so that we're comfortable with that. And then we would do a reperformance using our audit software. So there's going to be a little bit more risks, or sorry, more tests if we have a lower level of risk. Then we get into reporting. So if it's a publicly traded company, Sarbanes-Oxley requires that to be audited separately. So there's going to be communication, obviously, of any material weaknesses with the audit committee as well as the client's management. Their management letter will be written, and in that management letter, there can be less significant weaknesses that are addressed, and then maybe just some areas where they see like opportunities for improvement that the auditors will mention maybe what they could do in order to have stronger internal controls in the future. So they can either issue an unqualified opinion where there's no material weakness and there's no scope limitations. They could issue an adverse opinion where there's one or more material weaknesses, or they could do a qualified or disclaimer if there's scope limitations. So again, it depends on the level of the scope limitations, and if they were able to get comfortable, you know, in another way. Okay, then we also have, well, what if they're not publicly traded companies? So they're smaller companies that are not publicly traded, and that separate audit of their internal control structures is not required. So a lot of the similarities, I mean, a lot of the things we already talked about are similarities, like whether they're public or non-public, we could do those same type tests, and those same type walkthroughs and inquiries and all those things. But some of the differences related to the public versus the smaller non-public or private companies is that the reporting requirements, that we're not required to audit them separately, so that isn't required. It's just going to be a focus that the focus is going to be for the auditor to be able to assess their risk of misstatement. So they're going to look at the internal control structures of a non-public company just to be able to assess that risk. The extent required is going to also be a little bit different because small companies don't have the personnel to really establish adequate separation of duties. However, even if they can't adequately separate duties, they still should hire competent employees. They should still have proper procedures in place, adequate documentation, and physical controls. So, for instance, before I worked at the oil and gas company, I worked at a plastic injection molder. It was a small business, not publicly traded, and I was the only real accountant. So I had an associate who worked under me. She did not have a degree. She did a variety of different functions, but I mean, I was really the one that did all the accounting. So she did help enter. She was more in purchasing, so she would help purchase product, and then she would enter in those vendor invoices into the system. I would then pay them. I did all the payroll. I did all the invoicing of the customers. I collected the payments. So there was a lot of things that I did that would have been like not an adequate separation of duties. But again, it was because we didn't have the personnel to do it. But we still had proper procedures, like we still had pre-numbered documents. I never shipped an invoice until all the goods were pulled and on the truck, and the transporter came and brought me the paperwork or came in to request the paperwork. And then there was always proper signatures for the people who were placing those orders. Like we had maintenance personnel who'd come in and place the orders with the purchasing person and then sign off on those. So we had all the procedures in place. There just wasn't enough employees to really do that adequate separation of duties. So that's what happens sometimes in small businesses, but you still want to have the procedures in place, and you want to have competent employees, and you want to do what you can to actually have some of those proper controls if you can. Um, the the auditors are going to want a sufficient understanding of the internal controls so that they can just assess control risk. And the extent of the test of controls, like we had on that last slide, is not needed for private companies. Then the last section talks about auditing the IT environments. And again, I feel like this is pretty technical, so I'm just kind of going to give you an overview. I feel like to get into really all that nitty gritty is almost just really too technical for our purposes. So a couple ways they could do it though, they could do a test data approach where the auditor inputs some test transactions into the system, and they're going to have expectations when they put it in what is going to be the outcome. So they want to look at it to say, okay, well, what happened when I did the batch? I put in these 3 invoices, whatever it is, and it's going to pull from your vendor files and your like your property files or your product files, or kind of those master files. And then like what came out when they process this batch, and then they're going to make comparisons to what they anticipated as to what they were putting in. So like that would tell you if it worked. So say if they did a test to say, well, I'm going to put in a wrong property number, what's that going to do? I'm going to put in a wrong vendor number, what's that going to do? I'm not going to have it balance. I'm going to use the wrong general ledger account. Those types of things. So they're going to test just to make sure that everything is working in that IT function properly. Then they may do a parallel simulation where they actually input it into their program and then compare it to what the client's program showed, looked at the results and make comparisons to say, okay, when I put these same transactions into my program, again using the master file provided from the client, what are the results compared to if I'm putting those same things into the client system, what are the results? So again, they could get to the same answers, and then they would feel comfortable that those IT environments are working properly. Okay, so that is it then for our internal controls. And then that really is it. Our next chapter, we will get into like the overall audit. So we've completed our internal control structure.